Hey everyone, and welcome. Today we're diving straight into the absolute heart of finance, the relationship between risk and return. And look, this isn't just some dry academic concept. It's the core logic that powers every single investment decision you'll ever make or analyze.
So, this is the big puzzle, right? We put our money down today for a tomorrow that is completely uncertain. So, how in the world do we apply any kind of discipline or science to what feels like a total guessing game? Well, believe it or not, financial theory has a surprisingly elegant answer, and that's exactly what we're going to unpack today. I mean, when you start listing all the risks an investor has to think about, it's just overwhelming. You've got everything from a key factory burning down to a sudden change in government policy or even a global pandemic. Trying to track each one of those things separately, it's pretty much impossible. So, the first brilliant move in finance is to find a way to boil all this chaos down into something we can actually work with. So, here's our game plan for this explainer. Think of it like a funnel. We're going to start broad by defining what we even mean by financial risk. Then, we'll split it into two crucial types. After that, we'll see how to magically get rid of one of them, figure out how to measure what's left, and finally, learn how to put a price tag on it. It's a really logical path from total confusion to, hopefully, total clarity. All right, let's take our first huge step. Instead of getting lost trying to track every single potential problem out there in the world, modern finance makes a really important simplification. It defines risk as something we can actually measure and manage. And this simplification is a total game changer. So get this, in finance, risk doesn't actually mean the chance of something bad happening. Nope. It's simply volatility. How much does a stock's price swing up and down? A stock that jumps around all over the place is high risk. One that's pretty stable is low risk. This simple shift lets us capture all those complex dangers in a single number. Okay, this next idea is absolutely fundamental. For any finance students out there, especially if you're gearing up for exams, this is a must-know. We're going to take that one idea of volatility and split it into two very, very different types of risk. This lays it out perfectly. On one side, you have market risk, which is also called systematic risk. The best way to think about this is like the tide that lifts or lowers all the boats in the harbor. Things like interest rate changes or a recession, they affect pretty much everyone. Then on the other side, you have specific risk. This is like a leak in just one boat. The CEO gets fired, a new drug trial fails, a factory has a fire. It only affects that one company, not the whole market. And this brings us to one of the most profound takeaways in all of finance. Seriously, the market does not reward you for taking on specific risk. And you might ask, why not? Well, because you can get rid of it so easily. The market isn't going to pay you extra for taking a foolish gamble that you could have completely avoided. The only risk you get paid a premium for taking is market risk, the one that you're forced to accept just by being in the market. So, if that specific risk is unrewarded, how do we get rid of it? Well, this leads us to one of the most powerful and I'd say almost magical tools in finance, diversification. This is how we filter out all that company-specific noise. Let's look at a really simple example here. We've got Heineken, a lower risk, lower return kind of stock, and then we have Ericsson, which is higher risk and offers a higher expected return. On the surface, there's no obvious better choice, right? It just depends on how much risk you're comfortable with. But what if we don't have to choose one or the other? This question from our source material gets right to the heart of it. Instead of putting all our eggs in the Heineken basket or the Ericsson basket, what happens if we combine them and create a portfolio? And this is the magic I was talking about. If you just took the average of the two stocks' risks, you'd expect your portfolio risk to be 13.5%. But the actual risk of a 50-50 portfolio is only 11.8%. So why is it lower? It's because the stocks don't move in perfect lockstep. When one zigs, the other might zag, and these imperfect movements cancel out some of that company-specific noise, lowering the whole portfolio's volatility. Okay, so we've used our diversification wand to make all the specific risk disappear. Now we're only left with market risk. The question is, how do we measure it for any given stock? For this, finance gives us another critical tool. And for anyone studying for an exam, you are definitely 100% going to be tested on this. Say hello to beta. Simply put, beta measures how a stock moves relative to the overall market. So the market itself has a beta of exactly 1. A stock with a beta higher than 1, say a hot tech startup, is going to amplify the market's movements. But a stock with a beta less than 1, like a steady utility company, will dampen them.
It is the single most important number for a stock's market risk. So where does this beta number even come from? It's not just random. It's rooted in the real world of the business itself. Companies in sectors that are super sensitive to the economy, or companies with high fixed costs, or a lot of debt, they're naturally more volatile, and that real-world sensitivity is what gives them a higher beta. Understanding this connects the dots between theory and actual business analysis. And just like that, we've done it. We've defined risk, we've split it in two, we eliminated the part you don't get paid for, and we've measured what's left with beta. So now it's time for the grand finale, connecting that risk measure to the return an investor should demand. And this brings us to the famous capital asset pricing model, or CAP for short.
Let's just pause on this for a second, because this is the central idea that the entire CAPM model is built on. The return you should demand from an investment isn't based on its total overall volatility. Nope, it's only based on the part of its volatility that you can't diversify away, which, as we now know, is its market risk, the risk we measure with beta.
And here's the formula itself. Now, don't let it scare you. It's actually really intuitive once you break it down. First, you start with the baseline return you could get for taking zero risk. That's your risk-free rate. Then you figure out the extra reward the entire market gives you for taking on average risk. We call that the market risk premium. And finally, you adjust that premium up or down based on your stock's specific beta. If you have a high beta stock, you demand a bigger piece of that market premium. Simple as that.
Okay, let's make this real. Using some numbers from our source material, take a look at Tesco. With its low beta of 0.83, investors only require about an 8.3% return. But for the much riskier airline Lufthansa, with its high beta of 1.31, investors demand a much higher return, over 11.3%. It's a direct relationship. More non-diversifiable risk requires a higher potential reward. The formula just puts a number on it.
Now, if you were to plot the required return for every possible beta on a graph, you'd get a perfectly straight line. And this line has a name. It's called the security market line, or SML. You can think of it quite literally as a picture that shows you the price of market risk. In a perfectly efficient market, every single stock and every investment should sit right on this line. And this is where it becomes a super powerful tool for analysts. If you find a stock whose expected return is above that line, it means it's offering a higher return than its risk level says it should. It could be a bargain. And if it's plotting below the line, it's not offering enough return for the amount of market risk you're taking on. It might be overvalued. So there we have it. We've gone from a totally chaotic universe of risks all the way down to a single, elegant equation. The CAPM is really the bedrock theory for how we price risk in financial markets. But its beautiful logic rests on one gigantic assumption, that all of us investors act perfectly rationally all the time. The real world, as you and I both know, is often a little bit messier than that, which opens up a whole other fascinating rabbit hole. But for understanding the core theory that drives modern finance, this is the essential framework.